Portfolio Builder members, welcome to our emerging markets class. We have some of our regular gang on today. Gary, Henry, Jeff, John, and Mark. I'll open up the mic a little later after we get through our presentation. I'm adding a little extra content to our daily webinars where we'll cover all the most important economic data, opinions, and news that's hitting the press each day. So some of it will be related to our specific holdings in the emerging markets portfolio, and some of it will also apply to our American-based equities. All right, so first slide is we have the tariff man raising prices faster than a speeding bullet, trade war, higher prices, job losses. So the big headline this morning was that there was a trade deal ready to be sparked, an announcement of Trump meeting with Xi, and supposedly today White House has come out and said that is not true, and so of course a lot of volatility in the markets from that. If you listen to Ray Dalio, he says he just went out on Bloomberg yesterday with a nice 45-minute interview, and basically is predicting America will enter a Great Depression in the next 2 years that will last for several years, and looks at the period between World War I and World War II with the tariffs, with the inequality, with the populism. So we'll definitely be taking a look at some of those thoughts. This is an article which, if you want to view the link, it's right there in the PowerPoint. We'll provide everyone with a copy, pointing out that we're very close to the longest expansion since 1857. So people are becoming more and more cautious about how long this can last. And he makes some good points, which I'll summarize in terms of this was actually a reflection of Charlie Munger's recent shareholder letter, where essentially he talks about how he got so rich, him and Buffett, and it was just by simply not being stupid instead of trying to be really smart. And I really like that quote. That really hones in on what we're trying to teach with our program, is how to play it safe and not be sorry. So first comment, one, despite the turmoil of the fourth quarter, the stock market has rebounded sharply and now sits confidently just below the all-time highs of September 2008. However, a closer look at the entrails of the stock market tells a different story. Since the end of August 2018, cyclically sensitive stocks such as energy, financials, and materials all remain down by roughly 10%, while defensive sectors such as utilities, staples, and real estate are up by 7%. Two, the bond markets around the world are signaling concern as yields are falling and curves are inverting, a historically durable sign of economic slowdown. Not to mention we have all the central banks telling us that's what's happening. The amount of negative yield bonds globally has risen dramatically from less than 6 trillion to over 10.5 trillion since October of 2018. Economic data in the United States has been disappointing for the balance of 2019, although the job market has been very strong. China's debt to GDP ratio has risen from 150% to 250% over the past 10 years, and according to the Wall Street Journal, the credit multiplier is weakening, where 1 yuan of credit financing used to produce 3.5 of growth. It's now only getting a 1-to-1 ratio. And the housing problem around the world is really what could potentially be the big drawdown. So 22 million homes unoccupied in China. And so that is a big picture that the Chinese have to deal with. Federal Reserve has formalized the move to a much more dovish stance in the first quarter, and now the bond market is predicting that the rate will be cut to 2.07 from 2.5. So there is a big disagreement with stocks in the bond market currently. Then JP Morgan, of course, has the quant battle going on. Marko Kolanovic has a very bullish thesis since last year and is continually betting that S&P 500 will hit 3,000. Now he's out there saying it might hit by May if we have a clean Brexit breakup that's not too disruptive and a US trade deal. And if, that is, earnings season is not a complete disaster. But straight out of their other quant, a Greek fellow says that investors should start building up hedges against the risk of a repeat of the past 2 weeks yield curve inversion episode. Points out that the global PMI is still deteriorating and that the global GDP revisions continue to be to the downside. And Mike Whitley, real quick question. Do you recall his prediction of what the SPY will be worth in the future? I forgot. Well, Buffett is bullish on stocks and hates all other investments. His portfolio is very similar to the SPY ETF in a lot of ways. In terms of predictions, he's not the kind of guy who does predictions. He doesn't think he can predict recessions, and he doesn't care about them. He says he just was interviewed by Bloomberg recently and doesn't care about recessions. Looks forward to them. Now, if we look at the probability odds for a recession, we can see that the S&P 500 says there's none. High yield credit has 20% odds. But if we look at the Treasury market, the odds are rocketing higher. So we had the head fake on the China deal, which was interesting news today. And of course, this sent the S&P 500 much higher today, although we didn't see the same sort of reaction in emerging markets, which we will jump into in a moment. You can see that all the economies outside of America are really slowing down quickly in terms of trade. Similar data. World Trade Outlook indicator is negative, below trend. Of course, this is the key thing that is freaking out all the central banks, and it could potentially all be tied to this this fear of tariffs and a trade war. So they are all have a fire under their butt to make something happen here. Otherwise, most certainly, things will continue to deteriorate. And the last standing card is still the United States. That's perhaps why so much capital is flowing into our treasury market as well as our stock market. And so far, the jobs market continues to improve. Germany weakening, not as bad as that 2009 bars you can see, but still a bad sign. And so the big question is whether these two countries can really get along, or are they going to do something more similar to perhaps what we saw from post-World War II, as we had this big fear of communism. So will they really let China creep into the lead economically, or is America going to do everything they can to try to slow them down? So right now they seem to be smiling and taking pictures, but will that really be the case? So I am somewhat doubtful of that. This is the Manhattan housing market. You can see the high-end portion of the market is really losing value quickly. There's an article about 50 Cent in Connecticut, a rapper fellow who bought a house that was, I think it was worth something like $8 million, and he had to sell it for $1 million at a 90% loss. The car market is a big favorite for a lot of people who try to predict recessions, and we can see that all the major American car companies had a pretty significant slowdown year over year. The rise of the BBB company. If you listen to Jeffrey Gundlach, he is very bearish on these BBB credit bonds, that most of them should not be graded at that level, and that this is going to be an implosion. Just a look at the tremendous debt that China has been taking on. And now Bitcoin's back on the scene. Bitcoin has continued to stay above 5,000, which is very interesting. And so as long as governments are creating deficits and central banks are printing money and interest rates are at negative, it makes a lot of sense to own gold and Bitcoin. So definitely interesting to see if Bitcoin can maintain this $5,000 plus. Mark says, what should the BBB rated be? Yeah, if you want to watch his presentation, he goes into great detail on that, but they should be rated lower. Most of the companies in the BBB rated credit are too high rated. They should be lower rated. The economic surprise index has lost the correlation to the stock market. This chart is looking at the economic data relative to other years, and we can see it is a very rough start relative to most years. Yet we have a stock market that is flying up. So this was the big jump in the China manufacturing PMI that has been the big news this week. We can see the other, the services and the composite are still negative. Japan in a negative path, Italy in big problems, France negative, Germany very negative, the whole Eurozone is negative, and so the world index is going up while the economic surprise index is crashing. Okay, so definitely some things are not adding up. Let's switch over to our trade alert today. Then we'll look at some charts and open up for Q&A and perhaps do some demonstrations. Now Mark's asking if defaults will increase. Yes, that is the prediction, that the defaults will implode. Okay, so let's go through our trade alert. Trade war truce, will it be enough to end the global bear market? So it doesn't feel like a bear market. Clearly in the States with the stock market going straight up. And what's even more confusing is that there's been very little actual people buying equities and enjoying these profits. It's been primarily just the corporate buybacks and perhaps central banks. So very few people enjoyed much of this run-up. Scrolling down is a summary of our program on the emerging markets. This helps us allocate some of our capital outside of the American corporations and into the big stories in China and its core partners. So that is where BlackRock and a lot of big money is starting to flow into, and makes good sense for people in our program who want to generate consistent retirement income to reduce some of their risks of being completely concentrated in the Americas. So if we scroll down, here's our track record as of covering the trades, the covered calls. So this gives us a better idea of our real P&L on this program. It is currently underperforming our SPY program at 5.2%, but not doing bad. And I believe in the long run, there's a lot more room for growth in these assets versus the SPY strategy or the high yield version of that. But that just hasn't been the case yet. And so let's take a look at some of the trades we did today. So first we had to cover last week's trades, which for the most part was a loss on the covered call, but that means we've created a profit on the underlying ETF. So anytime we have to cover a covered call for a loss, that means we won. And a lot of people have been calling in, what's your win rate and things of that nature, but it's very misleading. If you go down the covered call P&L, you might think all the 98% gains were the best series of trades, but that's actually the opposite of being true. When we get 100% profit on the covered call, it means our underlying asset potentially lost value. So the best scenario is we get maybe half the profit on the covered call and our underlying asset appreciates. So that's what we really want to see. And so what really matters is just watching the total P&L grow slowly over time. So our goal is not to throw out a bunch of risky trades and hit big gains like a lot of alert services. Really, we're trying to truly protect our capital at all costs, even if it means making very little money for certain periods of time. And so that's the case today. We covered those positions and wrote this new set of trades. And when you see the ROI over here is 3.6, 4.4, 2.7, 5.8, that's the level of protection we have from now until next Thursday on each of these positions. We're not going to make that exact profit between now and then, much less. We're not trying to make that much profit. And in general, all of these programs, we're aiming for between a 20 to 30% annual return. If we do better than that, it will be because the market is going up and we're getting profits in two ways, in our underlying asset and in the covered call. Whereas if we are in a bear market, we're going to be making all of our profit from the covered call and also protecting the devaluation of our underlying assets. So it's important that when you do this game that you own the best securities in the world. And so that's what we have right here for the emerging markets. Now scrolling down, we can get a feel for the emerging market ETF, EEM. This is the second highest traded ETF in the world, only after the SPY and neck to neck with the QQQ. And you can see its recovery from the highs of 2017 are nowhere near done. We're only halfway through. And so the big question is this bear market really over? Or are the emerging markets going to collapse further and tug America down with it? And so the central banks are indicating that they're fearful that this bear market is not over and that there is more trouble ahead. And if we look at the option market for the EEM ETF in the next 8 days, there's a heavy load of volume flowing into put options. So that doesn't make sense. If US and China are about to strike a trade deal that will go down in the history books, peace with North Korea, that would be big. That would be very bullish. So why is the market betting down? We chose the 42.50 strike to give us some protection on this position from now until next week. And there's very little profit if we get assigned. If we get assigned, we'll essentially break even, I guess, $3 profit baked into the cake. However, if we trade between 44 and 42.50, then we can generate some profit from our covered call. Here's the China. So if you take what's under the hood of the emerging market ETF, you can look at which countries it invests in. And unfortunately, we can't, for the most part, hit many of these companies directly, not without a lot of work and getting into very niche markets from the States. So that's why the ETFs are ideal. And the first most important ETF in our portfolio is FXI. This is the China Large-Cap ETF. And so once again, you'd think with the sort of rumors floating around this week that there would be some bullish option data. In this option chain, we can see an incredible 117,147 option contracts today purchasing the 44.50 put option. That is a great deal larger than I would expect. Now you can see there's a tiny amount of volume flowing through the call options, and there was a good deal of open interest for the call options. But today the market is clearly bearish on this position. So we wrote the 43.50 strike. South Korea, often used as a canary in the mining. It's very, very sensitive to world trade, and so it's also behaving somewhat bearishly. Not a lot of option volume in this ETF, but luckily in our total portfolio, it's a very small part of the puzzle, and so you don't have to write a whole lot of option contracts. We chose 61.50. Market had a little volume on the put option, but there's really not a lot going on here. So with this one, we're really just playing that the South Korea ETF is going to be correlated to the two above. Now, India is very unique. Its bond market, I believe, is at 8% right now. So it's one of the few economies that is confident enough to have high rates. So it's a very attractive place to park money right now. They have, I believe, the second largest population, and it's been growing at a faster rate than China. So there's a lot of reasons to be bullish on India. It's still a very corrupt country with a lot of problems, of course. That's why it's still where it is, developing. This one has very little option volume. We wrote right at the money at 35.50. Russia, one of the major partners for the Chinese, but still a small fish in the grand scheme of things, right at the money at 21. Not a lot of action going on in terms of the option market for this one. Now, Brazil is a very highly traded ETF and does have a much better option market, and the volume once again flowing into the put options with very little into the call options. So once again, we're protecting some of the profits we earned over the last week, and assuming that we're either going to go flat or slightly down from here till next week with that 39.50 strike. Gold, you'd think, be skyrocketing with all the dovishness in the Fed, but it's still just kind of flatlining here with the GDX ETF. Option market is a little bit bullish today, so we did write the 23 strike, so we can get the double payday on this one. We can have the underlying asset appreciate and enjoy some income from the covered call on top of that. And silver was just flat. We wrote right at the money so that we can at least generate some return regardless of if this ETF just trades flat. Now let me flip over to the spreadsheet. I had a doctor somebody write in that our program looks fascinating, but he thought the trades looked sophisticated and complicated. So I'm going to put a quick little tutorial on for how to do the trades, just so you guys can see just how easy this is. Let's say we wanted to do the emerging market trade today. So step one, you would have to purchase 100 shares of the ETF. Okay. So I think everybody knows how to buy ETFs. Step two is you're going to go to the options. And our program really just does two things over and over and over again. Step one is we sell to open. And this is expiring on the 12th. So I just grab that date. The strike is 42.50. It is a call option. And if the spread is relatively tight, a few cents, I just go with the market order. If I'm a little concerned that the spread is pretty wide, I might do a limit order. Now, some brokers do not allow you to do that. That's how you open the position. So how do we close the position next Thursday? Buy to close. So it's just that easy. Then what would we do? We would go to the next expiration and sell to open. And then what are we going to do? A week later, buy to close, grab the next date, sell to open. So it's a very repetitive, easy to predict program. You know the underlying ETFs. You know in general what we're going to do. You know when we're going to do it. And what's neat is we also give you the tools and education so that you can modify it to better fit your needs. And as we've seen in some of the past webinars, we already have students who are modifying the templates to make it better for their personal goals. Now, what do we do as we close these trades out? We just copy this part and paste it down below. So you can see if you were not educated on how a covered call strategy works, you think we lost a lot of money this week with these huge losses here. But the truth is our underlying asset went up in value, so we didn't lose anything. We just covered the position. It's during the times where we have all 98% profits and we're able to cover for a penny that you got to question what happened on the other side. So that's a big confusion for a lot of people. Now, from time to time, we may put some hedges onto our portfolio. And in this portfolio, it'll be index-specific put options that relate to the different indexes. So we're currently not doing that yet. We're just using the covered call. But if things did seem to be getting very troublesome, this is where we would add those put options to protect our assets. So that's a good summary of our emerging markets class. And as you can see, the return on investment says 10%, but it's really at 5.2. So you got to realize every time you write your covered calls, it's going to distort what your true ROI is until after you've covered them the next week. Mark says, will Japan implode before Europe? I don't know. And again, that's one of the things I don't try to do is predict the future, but what I like to do is react to the circumstances we are living in. So certainly Japan has printed a ton of money and is probably one of the biggest buyers of the US equity bull market in this year. So they have taken the idea of low interest rates to an extreme, and it may be where the rest of the world is headed. We will see. Let's see, what other questions? All right, guys, I'm gonna go ahead and unmute everybody. And if you do want to mute yourself, you can self-mute.
I'm sorry, 1 second.
Welcome to the webinar.
Yeah, so that's a good point. Mark says, yeah, let's repeat what does not work in terms of the Japanese. So, my thought is that the Fed may just surprise everyone and actually raise rates, which I think would punish the rest of the world just as it did in 2018 and further strengthen the dollar. So we'll see. It's the bond market's betting the rates go lower. But when we look at the big picture with this fear of China becoming the leading power, you can start to see where there might be some conflict ahead. And really the dollar is America's biggest asset. Who knows that? Any other questions out there, guys?
Hey, Jason, doesn't a strong dollar hurt our exports?
We want a relatively strong dollar. All the big forecasts from Jeff Gundlach and all those folks is if we lose the reserve currency, that would be very bad for America, for our bond market. So yeah, we definitely want the dollar to remain strong, not too strong, but we also don't want it. Ray Dalio just came on Bloomberg and predicted the dollar will crash by 30%, which would be horrifying. Oh, Henry's ready to get unmuted. Hey, Henry.
Hey, I've got a brain freeze on yesterday's webinar. When we talked about the SPY at 285, right in the 287.50, you said you had a guaranteed of 50 cents. And I'm just trying to walk through that and see how you have a guarantee of 50 cents when you have to cover, when the SPY went up and you had to cover.
Sure. So that might be the case tomorrow. Let's go over that. I'll just pull up yesterday's trailer. So yeah, what's interesting is with the SPY, they're a little more generous with us being able to, what I was calling baked into the cake, profits that are baked into the cake. And that was the opportunity we had yesterday with the SPY trade. But you can see we didn't get that same baked into the cake profit on our EEM trade today. So whereas if the EEM jumps, we're going to make like $3, which does, for many of you, that will hardly cover the assignment cost, which is usually like $10. Whereas on this one, we had that $50 baked into the cake. So let's look at that. Let's see what we want. Hey, Ryan, is yesterday's post on the web? I'm trying to find, looks like we haven't updated the blog with yesterday's post. I'll just grab the Word doc, guys, so we can pull it straight from the source. Oh, there it is. Okay, my bad. Okay, so here's the picture. All right, so let's look at this. Okay, so we can see real time as this trade was issued, the ETF was trading at 287.06. Okay?
Yes.
We're agreeing to sell our shares for 285. That's a loss. Why would we agree to sell our shares for a loss? That makes absolutely no sense, right? So let's take the difference. If we take 287.06 and the difference from 285, that's a $2.06 loss. Is that correct?
Correct.
Okay, what's the credit you're collecting?
256.
256. So what's the difference of losing $2.06 and then collecting $2.56?
It's a 50 cents.
And how many shares are there in one option contract?
100.
So if you get assigned, what's the worst thing that could happen to you?
Okay, so if you get assigned at 285, you're going to keep the 50 cents or $50.
You got it.
Okay, so that's the only way that guaranteed 50 cents is there is if you get assigned.
Well, the math works out exactly the same whether we cover it or we get assigned. So
Okay, but let's say that it moves up to 330 like it did the other day, and now you have to cover at round numbers 70 cents.
So yeah, so it's all relative to the change in value of the underlying ETF. So basically, you just can't lose in this proposition. We cannot lose if the ETF goes up for any reason.
Okay, if
Not
the
possible.
ETF, okay, if the ETF goes up and you have to cover at 330, you lost 70 cents on that on your short call. Okay, but yours basically saying because the ETF went up, it went up corresponding the same amount, so you really don't lose the 70 cents.
Right, you're going to make the same 50 cents no matter how high the ETF goes. It could go to 4,000 as far as we care. We're still going to make 50 cents.
But wait a minute, if I have to, let's say I have to cover the call at $3.30, so I take a loss of 70 cents.
The ETF will have had to go up in proportion to that to create that price.
Okay.
Let's look. We're in a situation where we could do this right now. So why don't we pull up a real chart so I can just show this to you?
Okay. So I'm having a brain freeze, you can tell.
Yeah, it's complex, math behind the option market, but if you just keep it simple here. All right, so here's our trade that we put on, right? Is that the same? All right, there's the one expiring tomorrow. Let's just say we want to cover this one right now. Let's see what our P&L would look like. Oh, what do you see? 50 cents, huh? So do you see the difference in those strikes right there?
Okay.
Bottom line, there's no free lunch. When we write that covered call, our profit on the upside is baked into the cake. There's no getting around it. There's no changing that. Now, trying to calculate what kind of profit we make if it goes flat or down is a lot more complex. So I don't even try to do that. But in general, with the strikes that we're picking that are somewhat close to the trading price, we can expect to collect around $50 to $100 3 times a week, 52 weeks a year. And that adds up. That really adds up a lot. If we get defensive, we're eating into our potential profit. So even if we do the $50 156 times a year, that's still $7,800 a year of profit from a $28,000 asset you own. Now if we start writing the strike price above the SPY, that's when we can make some serious money. That's when we could hit those 50 to 100% returns in a year because our underlying assets are going up in value and our covered call is paying off. Unfortunately, I just don't think we're in a, as much as I'd love to tell you, I think stocks will go up forever. I'm not in that camp. Sure, I think 10, 20, 30 years from now, they'll be worth more than they are now. But is there some risks in the horizon? Certainly. And so our program to play it safe. We want to help you protect your capital.
Okay, so basically, if it goes up and I'm assigned, I'm guaranteed my 50 cents. If it goes up and I'm not assigned, I'm guaranteed my 50 cents. Correct?
For the most part, yeah.
Okay, and then if it goes below 285, what happens?
You're losing.
I'm losing, but don't I keep my whole 256?
Right. So our break-even point is 50 cents below the strike. So at 284.50 is break-even.
Okay.
So you can see it's a cool. This is the best way to protect your assets without the risk of losing money. If we try to protect your assets in any other way, and you're wrong, you're going to lose money every second you have that trade on. That's why buying call options on the VIX or put options on the QQQ is a very, very tricky thing that really professionals do well and retail investors do terribly. So you'll see I'm very hesitant to put on the hedge. And we have a lot of advantages. We have small portfolio sizes. We can be very agile. We have a unique group of investors who are willing to show up and see what's going on once a day. Okay, most investors don't, John over here is part of our staff. John, he's had 30 years of catering towards rich people who, if you told them they had to check their portfolio even once a month, they'd probably spit their wine out and tell you to get the hell out of Dodge. So we have a very unique group of people who are willing to manage their own portfolios and basically manage their risk by adjusting this covered call. So it's the only risk-free way you can protect your ass and still generate a return. So that's what's really neat about the in-the-money covered call. Very simple idea. Right now, we're biting our tongue saying, oh, why do we write the covered call? These stocks are flying up forever. But when the mood changes and the market's going sideways or down, we'll be one of the few people, at least on the retail side, who's actually making money.
But wait a minute, under 285, don't I keep the whole $2.56?
Well, let's think about it. We wrote this when the price was 287.06. So if the market were to drop to 284.50, I'm basically broke even because my underlying asset lost $2.56 of value, and it was replaced with the credit.
Gotcha. Okay. So then
Now, imagine we were actually doing this daily. Let's say it drops to that today. We could cover that and write a new covered call even lower. So the more frequently you're willing to check your account and cover the profitable credits. So if we have a covered call that's generating a profit, you can cover that and write one even lower. So you can get even more defensive than we are. Now, it's a random walk, so I don't try to overtrade. I think the Monday, Wednesday, Friday routine is perfect. And I think that, doing it too much may not actually be in your favor. Thomas has his hand raised, and let me see. Oh, I unmuted you, Thomas, if you like to chat.
Can you hear me?
Yes, sir.
Oh, okay, good. It's my first time calling. On the
Nice, welcome.
Good. On the TBT, when your stock price goes above your call, your short call for the week, do you just roll it up, or do you sell everything out, or you let them take it?
Yeah, good point. And actually, another guy on our staff's been dying to roll this position over. So yeah, let's talk about that. The TBT trade is for folks with potentially less capital because it costs less to get started. You can buy 100 shares of TBT for $3,350. So it makes it a very attractive, low-cost way to get involved. And so this product, this is one of the biggest problems in the stock advisory world in general, is that you have a big audience of folks who really don't want to do a lot of trading. And then you put them in front of a super pro trader who has been trading his entire life, 30 plus years, and they want to trade when they think it's the best time. So you end up with wild trade alerts left and right, and then nothing, and then people don't know how to put one and one together. They don't know how much capital to put in. They're getting the trades too slowly to react to them. This product for the TBT only trades on Friday. So all instructions for that product by design are limited to Friday. Now let's talk about the underlying asset and if that makes sense for this product. the underlying asset is a speculation, is the inverse of this 20-year Treasury note.
Mm-hmm.
So Treasuries rates very rarely fluctuate that quickly. And we just had a very rare circumstance where the rates all just plummeted. And so in general, I think it's a great idea to not be hyperactive and try to get crazy and micromanage this trade. Look at the 20-year note. You know, it's just between 2.8, 2.9, 2.8, 2.9, 2.6, 2.7. So it's just it's a data that it's a pretty stable product, which makes it very attractive to write the covered call. Now, if we took a similar product, which is the TLT, it's actually the exact opposite. The yield on writing a covered call in TLT is pathetic. It's about 1/4 of the SPY. So that's why, with our outlook, we think rates are rising over time. And this is a long period of time. We're not talking this week or next week. You know, we look at, here's, I actually have a better one I'll pull up. I finally found a effective federal funds rate going back to the 1700s, all the way back to America's first banks. And I'll try to pull that up in a second. But the big call is that we're going to eventually reverse this rates from ultra low back towards much higher rates. And current price we're looking at is getting up towards that 5 to 6%. So if that happens, and it could take 5, 10, 15 years for this to play out, this ETF is going much, much higher. So if it were to hit that rate, this would be at about 140. Let's just look at how far it's crashed, just to get a feel for how much the rates have been dropping. From 290 down to 33.50. And so, you know, are we going to protect the dollar? Are we going to raise rates? I think so. I think the stock market is going to be hot with all this free money sloshing around the world until we get rates to start rising. So we'll see. But once again, this is just a product that is already very low. I don't think our rates are going to go much lower.
Right.
So I'm very happy to sit there every Friday and roll over the position, and we're not going to be freaking out about whether it's in the money or out or not intra-week, because this is a play that we're going to do 10 years, 20 years. This is not going to change. The strike price on the covered call might slightly go up or down based on what the various hints are from the bond market or from the speeches from the Fed. But this is a long play that really adds up. It has about the same potential profit as the SPY program if you're doing that covered call and we go flat. Now we start to really pick up and I'm writing the strikes well above. We could be making a lot more than that.
All right, so you just roll every Friday.
So you only got to trade this one Friday. Yeah, we want your life nice and simple. We don't want you to, overwork yourself for nothing. This change in rates is going to happen slowly, slowly, slowly. So freaking out about whether it's up or down 50 cents today versus tomorrow is really missing the point. You're not seeing why we're holding the TBT in the first place.
And that's also the same with the SPY. You just roll it.
Now the SPY we're trading Monday, Wednesday, Friday. So I would say that the SPY is a little more fragile investment at the current prices and the leverage in it. And while the Fed does manipulate the treasuries, they do not have the abilities to directly. Now we do have Janet Yellen saying that they should add that the Fed could buy specific equities. Right now they can't. They can only buy primarily the treasuries. So they certainly manipulate the rates to be attractive to help the entire big picture. So it's nice that the SPY does allow us to protect our assets more aggressively, and I would say you need that for that product. Now you can do both of our strategies combined if you simply take some profit or some allocation out of your income. So if I wanted to do this together in one spreadsheet, that's how I would do it. Now you can see all of a sudden I should sell 300 shares of the SPY and pick up 3,000 shares of the TBT. For making everybody coming into the program having a very easy understanding, we've just simply separated it so you can see the TBT trades right here and the SPY over here.
Okay.
Which program are you thinking about following, Thomas?
I would probably do the SPY and the TBT.
Okay, cool. So what kind of ratio are you thinking in terms of your capital allocation? Do you want me to pull up your spreadsheet and kind of fill it out for you so you can see how to get it going?
Not at the moment. I have other things on my screen I'm working on.
Oh, it won't be your screen. I'll pull it up on my screen so that everybody watching could just see how it get launched.
Well, it would just be 100 shares of the SPY and 100 shares of the TBT.
Okay, let me, I'll throw that in for you and we'll show you how to get it all launched. Tom, okay. Now this is a pretty neat feature of our product, is that we can help you manage your spreadsheet remotely thanks to Google Spreadsheets. Now if that creeps anybody out, I would note that we do have 3,000 spreadsheets out there and they're being constantly updated. We can see all the activity going on and we really don't care what you're doing over there, so don't. Okay, so let's see. I'm not sure why you got this error right here. I'm going to issue you the newest sheet. It looks like you have the just the basic freebie sheet. I'm going to give you the latest, greatest sheet. Give it a minute. It will populate. So you might want to put your settings at something like 10% bonds, 10% cash, and 80% income. And that gets us a pretty good trade alert, except we have a little too much over here. So what if we go like this?
Looks like Bitcoin made a little move.
Yeah, Bitcoin, guess who predicted that? There's only one guy who's been accurate predicting Bitcoin in the past 2 years, and it's Jeffrey Gundlach. He called the crash December 2017, came out beginning of this year when it was at 3,000 or so, called for a technical retracement to 5K, although it looks like what it was some sort of crazy short squeeze over at the BitMEX. Okay, so look at this. So if I put you at 65 here, 25 here, whoa. So if you did something like that, you'd have pretty good allocation. The TBT does some sort of hedge for you to a degree.
Right. Okay.
Assuming that rates rise and stocks crash. And so, that's how you could launch this and trade both. you would have 28,000 of capital tied up in the SPY, 13,400 in the TBT, and you'd still have 8,000 cash, which whenever we get really scared and put the hedge on, you do want to have that cash on standby. As far as putting in today's trades,
What is the total account?
total account size on this one's 50K.
Okay.
Now, I did send you a new spreadsheet. Let's check that out. So that was our freebie template. I made the decision to let all our free trials see all of our products right off the bat, nothing to hide. And it's just nice to have everybody seeing the whole picture. So this improved spreadsheet I just loaded up, this is your new one. You'll have it in your Google Drive and in your email. I'll just throw that same settings in here. Does that seem like a reasonable starting point for you?
Yes, it does.
Okay.
Yeah. Now, where's it? Where do you have like an estimated return on investment for that program right now that you have set up there? Like what?
Yeah, our target is always going to be around 20 to. If we have a bear market or a flat sideways market, our target returns right around 20%. If we have a bull market and are not bearish on our end, we could generate a lot more than that. So it's all about where we write the covered call, and that dramatically changes our risk. So if we write the covered call above the trading price, we have the opportunity to break into 50 to 100% annualized returns. Unfortunately, I don't see that being the case for very long, that we will be so optimistic. In general, we're going to try to be pessimistic, play it safe, and accumulate very safe small returns. So if we do 20 to 30% in all of these programs, that would be my goal. If we do better, it will only be because the markets are going higher and we were willing to take a little extra risk during that period of time. Now, can we hit some big gains on our hedges? Sure. But I'm not really counting that. The main return I'm looking at is what we can generate from the covered call.
Okay.
Okay, so let me throw these new trades in. So just pretending you did it today. Well, let's look at all the trades we would do today if we were just doing this all right now. Whoa. You can put this if you like, you don't have to. The software just recognizes positive or negative. So if I wanted to sell these,
Okay.
I can just go negative. And you can see we're right back to a trade alert of 113. What if I pull that off? And now it says we have the right amount. Oops, now it does. Okay, so then let's go look at two trades we might put on right now, just for fun.
Okay.
So today's 4/4/2019. We're gonna write one for tomorrow, I suppose. Let's look at what the option market's telling us. And so another thing is, sure, it's nice to have somebody, you know, pull up the charts, look at the volume, take a screenshot, send it to you every day. But what if I disappeared? You know, my goal is that you get it. We show you how to do a very safe, consistent strategy. There's no secrets. You're going to learn how to do this all on your own if you needed to. Okay, so we're looking at the option ending tomorrow. And you can see the tremendous volume in this ETF. This is just in the options at the money expiring tomorrow. Look at the volume flowing right now, today.
The 61 cent?
And so, yeah, there's a lot heavy volume on the bullish side today, isn't there? Okay, so let's say we want to try to get a double payday. Let's say market's going to go up, and that's not the trade we put on, but let's just for fun, let's put on this one. The 287 for 63 cents, right in between the bid and the ask.
Mm-hmm. Okay.
We have one contract, it's call. If you want to track the contract name, you can do that. We were doing that because Yahoo Finance was, if you look at the code up here, was pulling us live prices, but that's been very unreliable. So I've been just using this space to show you guys what I'm covering for. I did have a quick question from Mark. Which option service do you use? I would recommend Robinhood because it is a great phone app and a desktop, but they pay for every single commission related to our product. So I would recommend that. They have just the best deal. Okay, now let's look at the TBT. Well, let's write one for next Monday. You know, we don't want to
Next Monday or Friday?
Don't want to overwork ourselves here on the smaller position.
Oh, so Monday you put the option on for the following Friday, right?
The TBT we're trading only on Fridays, so we're covering it on the day of expiration, and then writing another one for the next Friday.
Right, but since it's a startup account, you can put it on today for the following Friday.
Sure.
Right.
Yeah, it doesn't matter. This is a 10-year play. The TBT trade is a 10-year play at least. These credit cycles are, you know, not 1 week move. You know, this is not Snapchat or whatever. It's not the Lyft IPO or something like that. This is the U.S. 20-year Treasury. So it's not going to move a whole lot. But what's nice is because it's an inverse ETF, there are folks who will buy expensive call options predicting that the rates are going to rise by next week. You know, of all things, they think it's going to rise by next week. So we'll take that bet every week and win most of the time. Okay, so let's look at TBT. Now, I wouldn't be surprised if there's more volume in the put. Let's just see for fun. There's times where, as you've seen, I don't listen to what the market's doing, and so far I've almost been wrong every time. So it's hard to outthink the market. But again, that's us trying to be safer than sorry. All right, so where do we got? And what's interesting, there's been no problems having any members get these filled. So I would suspect that there are a lot of computers out there that look for your order and then place a bunch of correlated orders so that they feel like they have a guaranteed profit to enter that trade. So it's questionable if this is really speculators buying this because there's not a lot of volume in terms of probably most of this is actually some of our members. Mm-hmm. Okay, so we got 20 hitting the 33.50, just not a lot of volume at all. So on this one, our general theme is we think rates are going to rise. That's why we would hold this in the first place. So maybe the 34 for 16 cents. And we have 400 shares, so we can write 4. Now look, we broke both of these slightly above the trading price. But look at the ROI on this TBT. Let's see what kind of return we can make if we pull a 0.47% return for 52 weeks. And this also has upside potential. So we may capture half of that covered call and still get to keep some underlying profit with this one. All right, so if we start off with $3,350 investment, we grow it for 52 weeks, ignore the years, and the return is, let's just say 0.47. Let's see what our return is. This is just on the covered call. This does not calculate profit on the underlying asset, which again, we think it could possibly go from 33 to 140 just to get to historic rate levels. The historic average rate is 5%. Most likely we're going to overshoot that after we've overdone low rates. So this mindless trade, which seems like you're picking up pennies, has a 27% return just from the covered call, and it still allows you to appreciate your underlying asset.
Okay. Yeah, that's if you hit max every week, right?
That would be if our underlying asset was flat or didn't lose value. This would be the profit just from the covered call. Now, if TBT is going up, we will outperform that.
Well, that's if you get called away, right?
No, that's if the underlying asset goes up, we make more money than this. And if you want me to show you how that works, we could.
Well, is that still holding the stock?
The ETF, yes.
Yeah, the ETF. So when you roll it over, you're making money?
Right. So if the underlying asset goes up in value, we won't see the profit on the covered call. We'll see it on the underlying asset and maybe partially on the covered call. It depends on how much the underlying asset goes up.
Okay.
If the TBT goes flat, then this is more realistic to what our profit will look like. And of course, if the TBT goes down at a greater rate than our covered call income, then the net of that could be flat or a loss.
I'll tell you, options are very intimidating. That, you know, you have to know so much about that stuff. It's unbelievable.
Well, I think some of you guys try to make it a little more complex. Let's look at the actual work involved. So Friday starts. First thing you gotta do is buy 400 shares of TBT. Okay, you buy it. Good job. Now we're going to sell to open next week. We're just gonna look at the price. We're bullish on this index. That's why we're trading in the first place. Let's go one strike above. Quite frankly, this is the trade we'll be doing in this program every Friday for almost indefinitely until rates get to extremes. Now, if I thought that the Fed was really going to lower rates, as the bond market's suggesting it may, then I might write this a little bit lower, below the price, just like we're doing on that SPY. But that's not our forecast for the TBT. So how do we close it? Buy to close. Okay, now you're just holding the index again, the ETF. The next week we would sell to open the following week. And wherever the price is, we want to be 1 to 2 strikes above. The following week, buy to close. Then we're going to sell to open, go to the next week. So I just did 3 weeks of trades in less than 30 seconds, so it's not hard. There's nothing complex. This is not something where you can lose a lot if anything happens. This is not a option spread or a strangle or a calendar or a butterfly or anything of that nature. This is very
Netflix.
very, of all the options trading products out there, this is by far the most simple way you could do it. But I would argue it's smarter. It's just a smarter way to do a long-term strategy, especially when you're coming into the part of your investment career where you need to protect your cash. So the covered call is the only way outside of just going to cash that you can protect your assets and not risk losing cash like you do if you buy a call option on the VIX or a put option on whatever stock or ETF it is you're interested in hedging. Now the catch is you miss out on potential upside. Most of our clients don't need to worry about growth. They need to worry about protecting their capital and yet generating a return so they have some cash to live on. And so that's it. You know, if you learn how to do this simple strategy, you're really set for life.
Okay, and then let's say I wanted to get a stock with a dividend instead of, I mean, we can leave the TBT there, but let's say I want to, you know, have something that's a little bit more aggressive.
Then this portfolio is the right one for you.
Okay, you have to watch it a little closer though, because
this one trades every Tuesday. It costs $150K to build out this exact portfolio, but you could turn off some of these sections if you had less capital. I would probably recommend the bank stocks. If you didn't want to spend $150,000, you could build this out for $7,000. The banks have a lot of safety in them, which is smart for someone who is going into retirement. Has a higher yield than the SPY, and so certainly that's one option. But these are the leaders of corporate buybacks. That's why they're outperforming the S&P 500. And let me pull up our model portfolio on that one. Okay, now again, we did a few defensive trades, so this return on investment is slightly inflated, probably by like 3%. When I cover them next Tuesday, we take the screenshot in between rolling the position so that you can see what the real profit was. So right now we have around 3% cushion if the market were to have a little pullback. If you just compare the real ROI compared to what it's inflated to right here. So this is how I would recommend. This is what I call the high yield income. Now these stocks are by no means the highest yielding covered calls you can write, but this is the riskiest I would recommend my own father do with his own capital going into retirement. So sure, could you go find some other stocks that have, you know, great stories and explosive growth? Sure you could. But that's not what our product's all about. These are the biggest positions in the SPY ETF and the QQQ. When you think about it, if they have the highest level of trading volume and inflows of capital, and they're just going to go immediately dump it right back into these exact securities, that's one big safety net. You have a lot of cash constantly flowing into these names from the two ETFs. Two, these companies are making so much money they don't know what to do with it. They're buying their own stocks. Three, they have very good lines of credit. They can also borrow for cheap. And so they have outperformed the S&P 500, most likely will continue to do so for a long period of time. So by getting rid of the ETF, we do lose a lot of the diversification. Relative to like the S&P 500, Microsoft's a 5% position. In this one, it's 4 times greater at 20%. So we've concentrated your efforts into the core positions, and these are the brightest, best companies to place your capital for a long period of time, and then do the same thing. Now, what's neat? The market told us Facebook was going to rally last week, and it was one of the few bullish covered calls we did. Let's see what the market did as well. Now, what do you know? It has jumped considerably. Let me go to a 60-minute chart. So almost every time I have overridden where the market was placing its bets, we've ended up making less money than we would have just listening to the market. So if there's one thing that you really pick up on this, is you can simply pull up an option chain, look at the volume, and you have a pretty good idea of what the smartest people in the world are betting on for the short-term movement of these ETFs. So it does give us some good ideas of where to write our strikes. Now in general, once again, we're much more concerned about playing it safe, and when things don't add up, like when bond yields are crashing and the stock market's flying up, that makes no sense. So that's a good time to take pause and be a little careful. So sure, you know, there's certain times we override that, but in general, the whole setup here is we've picked the best underlying assets to hold for a long period of time. Number one. Two, we've picked assets that have an options market so that we can protect our underlying asset from the covered call and generate income. This allows us to have a profitable strategy even in a bear market. And then we look at the option volume week to week to get an idea of where to place a strike. So that's the plan, and it's something you can rinse, wash, repeat for decades to come.
Mm-hmm.
Jason, does the option always get filled?
These products are all, so here's the ones that are the least liquid. The Brazilian ETF's highly liquid, the FXI is highly liquid. TBT is the least liquid, and everybody I've spoken to is getting filled up to like $50,000 worth of underlying in terms of rank covered calls within minutes. So we haven't really tested how much volume can really flow through this, but I would suspect that if you let the order sit for 10 to 15 minutes, all the computers out there will, once again, they'll put on correlated trades before they take your trade. And if you follow like Jim Simon, he's got a bunch of PhDs. They've made so much. They've been doing 30% a year for something like 20 years, all with artificial intelligent computers, completely automated. So yes, you can get filled. The ones that maybe are a little light would be these three right here: EWI, INDA, RSX. If anybody does have trouble getting filled, please let me know. So far, I've had zero issues with people being able to write their options. But again, we're tiny, tiny fish in a huge ocean. And so that's why we can make returns that seem pretty ridiculous, 20, 30%. It's a big return. And it's just from the covered call. So it's not like we're forecasting some change of price has to happen. This is just from the current covered call prices. And we're in a low volatility environment. The higher the volatility gets, the higher the option premium costs. So our return can actually go up. That $100 every 48 hours might turn into 120, 150 if the stock market's going down and volatility spiking, because now option premium starts to go up. All right, last chance for a question. If anybody's got any, throw them out. It's been a very good webinar today, and I'm planning to get more and more topical content built into the webinars so that you guys are up to date with all the breaking news without having to spend half your time reading every source out there.
The phone number, in case I want to. In case I want to call, because every time I call, I can't get through to anybody. I have to leave a message. And
yeah, let me go. Mike, what's your number, Mike? See if he's still out there. We have two fine gentlemen who process customer questions and sales, John and Mike. So I'll make sure that you got both their numbers. I'll shoot you an email with it, Thomas.
thank you.
John has been in the bond market for 35 years, teaches tennis for fun out in Denver. Mike is a physician who retired and been following our products for 3 years or so. And so they can answer all your questions. They've got some discounts they can offer only over the phone. And yeah, it's a very hands-on company. Chat with somebody, save a little cash. You know, ask them if we're the real deal from their perspective. And I hope I can see you on the next webinar, Thomas. You think you can make it tomorrow?
I'm going to try. Tomorrow's Saturday. I can't promise, but I'll try.
Oh, where are you based?
New Jersey.
Oh, I think tomorrow's Friday.
You're from where?
We're in Albuquerque.
Oh, Albuquerque. I'm from New Jersey, right?
Oh, great. I think, aren't you out in New Jersey, Mark? I'm pretty sure one of our other members who's on the webinar today is out there. All right, gentlemen. Well, thank you so much for your time. Really appreciate it. We've got a growing audience, and I'm having a lot of fun helping provide value to you guys. Hopefully, you're enjoying it, and we'll have another update for you tomorrow.
Okay, thank you. Have a great day.
Thanks. Bye.